Hello, everybody. This is Matt Trader from Profit Mission Control. I hope everybody's doing good. I welcome all the traders and investors from all over the world. Today, we're going to be talking about position sizing. This is the topic that I chose to spend a good time preparing for and sharing with you my personal experience with it and its importance as an educational topic that is equally important as risk management, but it's one of the most, or I would say least, thought of by new traders. To me, if I had known this when I started, I would have avoided a lot of losses. Position sizing is really the most important topic in trading. You should spend a good amount of time researching, understanding, studying, and rationalizing in your mind before you even click that first buy button. The first time you jump into a trade, you're all excited, you want to buy it. You say, well, I've got this amount of money, this stock price is this amount, let me just jump in and buy that. Well, if you haven't really spent the time understanding this topic, you are destined to basically lose your money. So unfortunately, just like risk management, this topic is the least studied aspect of trading, often overlooked by new traders until they face their first account or second account blow up and then start scratching their head and thinking, hey, what did I do wrong? What went wrong? So my plan for today is to teach you probably three things. Number one is how to determine the right size of shares to buy in any given trade. So that's one of the very first questions that comes to everybody's mind when they start trading, but they never approach it in the right mindset. So I'm going to show you how I personally do it, and if it makes sense to you, you can also do that. The second thing I want to show you is why profit to risk ratio and accuracy are critical to a portfolio growth. So I talk about it a lot in my daily recaps and weekly recaps, where I am on my profit to risk ratio, what is my true profit to loss ratio, what is my accuracy. It's important. If you're not tracking those, you might as well not spend time trading, because it's the most important thing to portfolio growth. And then the third thing I want to tell you is how you can start with any account size and grow it successfully. So there is a tool that I've developed, which I personally had used in the past. I've tweaked it up, and I'm definitely going to spend some time sharing it with you today, which is my share size and portfolio growth calculator. And I can show you with that how you can take a small account and grow it. All right, so let's get started. So the infamous question. You have heard about this nice stock XYZ. I like it a lot, and I believe it's going to be a winner. I've got $5,000 equity in my account that I saved, and I'm ready to trade. The stock's price per share is $5. So how many shares should I buy? Well, you might have found this stock on social media, CNBC, whatever the source might be. You think this is going to be the next 10 bagger, the next Amazon, the next Bitcoin. And usually beginners think about it from their equity side and say, well, I've got $5,000. I've got, $5. The stock price is $5. They tend to think about their account size, and most of them, including me when I started, fell into, I would say, three types of people. So there's so many ways you can approach it, but I broke it down to three people. So let's look at those three people. We've got Mark, we've got Carla, and we've got Lynn. So again, these are just general categories. It doesn't mean that, this is all encompassing or all the scenarios that are out there. But let's say Mark thinks to himself, he says, well, I've got $5,000 and the price per share is $5, so I should buy 1,000 shares. If this moves up, $1, I've got me $1,000 in profit right away. Not only that, he thinks to himself, say, wait a minute, my broker also gives me 3-to-1 margin leverage. So I could buy even more stock, more shares. Let me grab, 2,500 shares. I know this is the one. He's going to take all his capital. He's going to buy 2,500 shares, use margin, and take it that way. So on an emotional level, he is on the greed level, maximum scale you can get on the greed level. Carla, on the other hand, she's a little bit more conservative. She's been in the market a little bit. She understands it's important not to risk all your capital. And she says, I've got $5,000, but I don't want to risk it all. So I'm going to only buy 2,500 worth. So that would be 500 shares only. Good thinking, but she's approaching it from an account size, saying that I'm going to take a portion of my account, and based on that, I'm going to divide by the stock price, and then that tells me I've got 500 shares. Third person, Lynn, he is more on the extremely fear side of the emotional scale. So he is very conservative. He said, I'm not going to gamble, taking the right approach. I'm only going to buy 100 shares. It's a nice round number and makes me at ease. So where did he pick that 100 shares? Pretty much just from a comfort level. He said, I can bite or tolerate the fact that I'm buying 100 shares. 100 shares on $5. That's only $500. No big deal. $500. I can live with that. So although they had all different answers, mostly emotionally driven, one of them is closer to the right answer, but their approach to the whole process or the whole question is all wrong, because beginner traders fall into this kind of trap. It's more of a chicken and egg dilemma. They say, is it the chicken or is it the egg? So let me talk about that. The thoughts that comes to your mind immediately revolves around, the two things that are natural to us as we start trading. Number one is, how big is my account size? Some people draw this line in the sand and say, based on my account size, I'm not going to trade anything above, $10, or I'm only focusing on penny stocks. The moves there are huge percentage-wise, and I can grow my account very quickly. So in general, the idea of account size and price per share, which is my second, egg. So that's the chicken and the egg, says price per share. So some people say, well, I'm going to only trade penny stocks, or I'm going to say I'm going to limit my price per share to determine how many shares I can buy based on my account size. Or I choose a random number of shares like Lynn did. He said, I'm going to buy 100 shares and use that with my account size to determine, what's the maximum price per share of a stock I should trade or invest in. All right. So I've got news to you. Now, if you haven't researched this topic, obviously, this will be news to you. If you have, then that's great. That means you've done some homework. So what's the news? The news is neither of these approaches are the correct approaches. These are not the first question you should ask yourself when you are thinking about share size. So these two data points are important. Account size and price per share are important, but not for determining the number of shares, but rather how many trades you can hold at the same time. And this will become more clear as we move along. So got it so far? So I guess up to this point, keep in mind that neither the account size nor the price per share should be your first thing that goes through your mind when you're determining your number of shares to buy on a trade. So what's important? So where do you start? Well, like I mentioned, don't think about your account size and price per share immediately. Okay, what you need to be thinking about, although these will eventually become important, you should be thinking about them last, right? So what's the important thing is risk. When we're talking about share size, we're talking about risk. So Carla and Lynn had some elements of that. They understood the risk of not spending a lot of your capital on a trade, but then they approached it from an account size and taking a portion of it and just saying, okay, here's the number of shares I'm going to buy. what you really need to be thinking about, and this is the most critical, important part you should learn, is how much you're willing to risk on a trade, okay? Not on your portfolio, not on the price per share, on a specific trade. As I enter a trade and exit a trade, how much am I willing to lose? All right? So let's think about what the calculation actually occurs. So it's a very simple calculation. Once you understand it and you rationalize it, you will become, I guarantee you, you're going to become a better trader. So how do you calculate the share size? Well, you need 4 things. I'm going to just mention them now, but then go in detail about them in the next few slides. So the first thing is your equity. What? You just said don't think about your equity. Well, yes, don't think about your equity from a point of dividing it up and saying I can afford this amount, but it's more of you want to know what your total equity is, right? The second thing is what's your maximum account risk, and that is a percentage that you're going to apply to your equity to say this is how much I am willing to lose. The third item is your round trip commission cost. A lot of people that talk about this topic totally ignore the commission cost. It plays a huge role in how many shares you should take, especially if you're starting with a very small account or small equity. And then the fourth item is your maximum trade risk. So this is how much you're willing to risk on a specific stock. And we're going to go in more details about these 4 items. But for now, what's the calculation? So the calculation is fairly simple. The maximum numbers of shares you can trade is going to be equal to the maximum account risk percentage times your equity, and you take away from that your round trip commission cost. So this is how much totally you are really risking on a trade. Divide that by the maximum trade risk. So if you're scratching your head a little bit and it's not very clear, that's fine. We're going to go over that in more detail. The most important thing to remember is that this is the equation you need to use to determine the number of shares, regardless of your account size, regardless of the price per share of the stock. You just need these 4 items. So let's talk about them a little. Number 1, your total equity. That's fairly straightforward. It's really how much money out of your pocket do you have in your trading account. So it's not your buying power, but rather the amount that if you lose, you will be totally out of the game. All right. So this is kind of your hard-earned money that you put into your brokerage account. And if you lose it, then you can no longer trade. So that's what your equity is. Very simple, straightforward. Number 2 is more important and requires more deep thinking on your part. And that is the maximum account risk percentage. So remember that, the maximum account risk percentage. It's a percentage number. It's a number you pick. It's a decision that you have to make. It's a percentage of your equity that you're willing to depart with if a trade goes against you. So if you enter a trade and you lose, it hits your stop price, right? You're going to lose a certain amount of money. So what percentage of your total equity are you willing to depart with? So that's what the maximum account risk percentage is. If you read into books, most books, gurus, investment advisors, they recommend you limit your risk to no more than 1% of your equity. So got that? No more than 1% of your equity. That's how you first start. You say my equity is $10,000. I'm only risking 1% of that $10,000, which is $100, for example. Now, in reality, that number can vary based on experience. So how much you've been in, how long you've been in the market, how many trades you've had under your belt, your account size, obviously, and not the way you're thinking. It's not by, if I have a small account, then I get, this percentage. If I have a large account, it's more about as your account grows further, your percentage will actually change in a different way. So we'll talk about that. Other factors, emotional tolerance. How emotionally are you attached to your money? How much of a risk taker you are? Again, this is a decision you're going to make based on those factors. Also, accuracy comes into play. So if you historically have had good accuracy, that means every 6 or 7 trades out of your last 10 trades are winners, that means you have a good accuracy. You can adjust that percentage based on that as well. So the point is, there are 3 kind of broad areas you can think of, good points to pick for your maximum account risk percentage. Between 1 to 2%, or even less than 1%, obviously, is considered low risk. So you're not risking more than 2% of your total equity in a single given trade. If you go to 2 to 3%, you are entering a zone which would be more higher risk. So you can still do it, especially if you're growing a small account, but you have to be very careful and very, very disciplined about obeying your stop losses. If you go more than 3% of your equity, you have officially become a gambler, and you might as well just go to the nearest casino and spend your money there, because the odds there are definitely going to be against you, and your likelihood of wiping out your account is much, much higher. So do not risk more than 3% of your equity on a single trade, and if anybody tells you otherwise, they are not really thinking straight or not giving you heartfelt advice. So if you are a small account grower, you can push it to 2%, maybe up to 3%, just a hair below 3%, but I would not recommend it as you start. But in any case, some cases, if your equity is very small, you'll have to go there, and we'll explain why. But generally, these are the 3 categories, less than 2%, low risk; 3%, less than 3%, high risk; above 3%, you're a gambler. So the point of all of this is to avoid wiping out your equity if you have a streak of losing trades. So if I go, enter this first trade and I lose, and then I enter my second trade and I lose. So there's obviously a limit of how many consecutive losing trades you can have before you wipe out your account. And the point of minimizing your account risk percentage is to delay the wiping out of your account, keep you in the game longer, have you more, in for the long haul. All right. So let's look at a table. This table, just for example, takes a look at, the lowest kind of risk and the highest kind of risk for a given equity. And this just, very simple math. It's, 1% of the 10,000 or 3% of the 10,000. So as your account is small, if you're starting with $1,000 or $2,500, in reality, you should not be risking more than, $10 to $75 on your account on a single trade. You should be expecting to lose no more than, let's say $75, right? Or $50. As obviously your equity goes up, and you take still a look at the 1 or 3% maximum account risk, your total equity or total risk that you are going to accept losing on a trade obviously goes higher. But most professional traders, they may decide to limit their maximum loss per trade to a certain dollar amount once their account size reaches a specific threshold. So, for example, I started the year at $25,000, and I was limiting my account to $500 per loss on a share on a specific trade. All right, which is at 25,000 here, so it's somewhere between those two, right? 1 to 2. Basically, my maximum account risk was 2%. So I limited it to 500, and you can cap it. As your account grows higher, you have a $100,000 account. Are you really going to risk $3,000 on a trade? Most likely, no. So that's why people start capping their maximum loss depending on their account size as it grows, right? As you reach the 100,000, 200,000, etc. So a lot of people put a cap of $1,000, but that's again a personal choice. So to summarize, this number 2 item is your maximum account risk. You need to decide what it is. You need to keep it below 3%, and you'll be in it for the long haul. All right. Next is your maximum trade risk. So we talked about that in the equation to determine your maximum share price is your maximum trade risk. This comes from the actual stock you are trading. And it's basically, in plain English, your stop loss. It's the amount that you're willing to lose from your entry point in a trade. So if its stock is $10, What's your stop loss? You say it's 25 cents, for example, 35 cents. That's what the trade risk is. It's a dollar amount. It's basically in cents or in dollars if it's a higher stock price. But it's the difference between your entry price and your stop loss, right? So it will depend on the actual stock, its average true range in a day. So some stocks vary or are more volatile during the day. The range varies between 25 cents on them up to $2, especially if it's a high price stock. But it's where you choose. You say, okay, there's this last support level, so I'm going to choose this number as my stop loss, and then from your entry to your stop loss, that is what your maximum trade risk is. All right, so let's take a look at an example of Pixelworks. This was a stock that we traded about a week ago. And if you follow me, you know that I always like to put these profit windows on my entries and exits. So this was a stock that came on our launch list, and we put an entry point above this, breaking this resistance of $5.51, with a profit target of 22 cents to $5.73, and an abort price at $5.30, which is the maximum stop loss. So I was risking 21 cents to make 22 cents, which puts me at a risk reward ratio of 105. Not necessarily the most healthy one, and you know why if you follow me long enough. I usually try to target 150% or more, but in this case it worked out, and the risk reward ratio was a little bit above 1, which is fine. The point I'm trying to make is your maximum trade risk is this 21 cents. So it's the difference between where you enter and where you're going to be stopped out. All right, so that's another element you need to make the calculation. So in this case, like I said, it was 21 cents. Now, I want to sum up those last 2 points quickly, is your equity and your trade risk together. And I'm going to show you kind of a chart that was developed through using my calculator to look at how many numbers of trades it's going to take you to wipe out, depending on your choice of your maximum account risk for a fixed trade risk of 25 cents. So let's say you have an equity of $5,000, you put a trade risk of 25 cents, and your commission round trip is $15, which we'll talk about in the next slide. But this is how fast, depending on your choice of maximum account risk, how fast you're going to wipe out your account. So if you start at a 0.25% of your equity, you've got 400 trades, consecutive losses before you wipe out your account. Obviously a very highly unlikely scenario, but it gives you a starting point. Now, we mentioned that on average you want to be between 1% and 3%, right? Now, between 1% and 3%, for this kind of example, you have 100 trades at 1% to wipe out versus roughly 40 trades to wipe out if you go the 3% route. Obviously, if you go more than 3%, we've talked about that, you're talking about single digits of number of trades, losing trades, where you would be wiped out. So keep this picture in mind. The lower your maximum account risk, the longer it will take you to lose your account. And that's the name of the game. You want to be in the game, right? You don't want to deplete your equity very, very fast. That's why the 1 to 3%, even 1 to 2% is probably a healthy area. 100 shares, 100 trades, to 50 trades. So keep that in mind. Now, the next one is the commission, which is fairly straightforward. It's obviously the cost of executing the trade, including routing fees. So this is the entry and exit. I can guarantee you 80 to 90% of the people that describe this topic never even cover the commission cost. It plays a huge role, like I mentioned, in your portfolio growth prospects. So, especially if you are, below a certain share amount, it's a flat fee. So let's look at the commission. So some brokers offer it for free, something like Ustock Trade, for example, or Robinhood. Others offer a discounted price, maybe $3 to $5. It can go up to $30 or more per round trip. The key is you want to make sure that you're calculating the round trip commission if you look at some of the examples I'm going to go over, the average is about $10. And with a smaller account size, the impact of commission cost becomes extremely magnified on the prospects of your portfolio growth. So we talked about that. All right. I want to share with you a couple of examples that I ran through my calculator to talk about, those last three concepts: the maximum account risk, the trade risk, and the commission. So number one, you saw this red line again before. So this is as your maximum account risk goes higher, the number of trades to wipe out goes lower, right? So this red axis here. Now on the other side, it's how many number of shares should you take based on your equity and a commission of, let's say, $15 round trip, and for three different trade risks. So here I'm saying I'm not taking more than 10-cent stop loss from my entry. This is no more than 25 cents, and this is no more than 50 cents. So as your account equity goes, or maximum account risk goes higher, the number of shares you can trade obviously goes down. Sorry, goes higher, because you are willing to risk more money, which is not necessarily healthy. So at 3%, obviously you can buy more shares, 1,300 roughly worth of shares, compared to at 1% you can only buy slightly lower than 400 shares. The point I'm trying to make with this chart is the obvious, is that as your account risk goes higher, the number of shares you can buy can go higher, but at a cost of potentially wiping out your account faster. So there is a trade-off. Your trade-off is, what is a reasonable number from a maximum account risk that I choose that enables me to buy a reasonable amount of shares without wiping out my account. Now notice the relationship between the trade risk, how many cents you're willing to lose on a specific stock, as a function of number of shares as well. So basically, as you increase your stop loss, the number of shares you can take on a given trade also goes down, because you're going to scale it that way. All right. So another thing to keep in mind, correlation that is very important to rationalize in your head before you even start taking that trade. So let's put all of it together. Let's go back to an example that we started with. Here's our calculation. We understand what the maximum account risk is. You're going to multiply that by your equity. You're going to subtract your round trip commission cost, and you're going to divide that number by the total trade risk, your stop, the difference between entry and stop loss. So let's take an example. We started with a guy who had $5,000. They wanted to buy a stock that was $5. But they said the round trip commission we're going to assume is $10. Their maximum account risk they're willing to take should be 1%. We talked about that as a conservative number. And the maximum trade risk, let's say it's 25 cents. So the stock they're picking, if it's $5, they're going to exit at 4.75, and it gives you 25 cents of trade risk. So you add that up, you calculate up 1% times 5,000 minus the $10 divided by 25 cents, and what's the number you get? You get $160. Sorry, 160 shares. So you need to limit the number of shares you buy to 160 shares. So given an account size of $5,000, a round trip commission of $10, a maximum account risk of 1%, and a maximum trade risk of 25 cents, you should not buy more than $160. Sorry, 160 shares. Now, do you notice something interesting about this chart, this whole page? The price of the stock, that $5, is nowhere to be seen on this page. So let that sink a little bit. The most important thing about share sizing has nothing to do with the stock price. You can use your equity to buy, obviously there's a scaling factor, but you can buy any share price per share. So, and I'll show you in the calculator how you can do that. But the interesting thing here is the price of the stock doesn't come into play. But what do we think about every time we go into a trade? the first thing that comes to mind is the price per stock, right? Oh, this is a $25 stock. I'm not going to buy that. This is a $50 stock. I'm not going to buy that. I want to stay in the comfort zone of, $5, $1, whatever. So if you haven't learned anything today so far, make sure you note in your brain that the stock price does not determine how many shares you should buy. All right? So is it worth it? Let's take a look at the prospects of portfolio growth based on the example we just covered. So let's say you took 160 shares with a loss of 25 cents per share. That means that if the trade goes against you, the total trade loss is going to be the 25 cents times 160 shares plus your $10 commission. That means you are going to lose a total of $40. Think about that. For an account that's $5,000, you're only going to lose $40. So what about profit? Well, if you choose a profit to risk ratio of 150%, which means now I know my loss is 25 cents, so my profit should be 1.5 times that amount, which is about 37.5 cents. So I'm going to say, 25 cents times 1.5 times 160 shares. And then I'm going to subtract from that my $10, right? Because that's my profit now. Gives you a net profit of $50. So if this trade goes in the right way, you are going to make $50 versus losing $40. Is that a winning proposition? Of course it is. But will it grow my portfolio? Well, that will depend on your trade accuracy over a successive number of trades. So that's where the timing of the series of trades that you take becomes important. And that's why you might want to tweak your risk ratio, profit to risk ratio. You might want to tweak your trade maximum account risk percentage to give you more growth, either in an accelerated way or in a slower pace, but more or less riskier pace. The key question though is, what's your accuracy? And if you know me, I talk about that a lot. But in this example, for example, if you have an accuracy of 50% or higher, this will be a net positive growth. Why is that? Because out of every 10 trades, let's say 5 are winners, 5 are losers. 5 times 40 is 200. That's how much you're going to lose. 5 times 50, 250. So you'll end up with $50 net profit. So the topic of profit to risk versus accuracy, we've talked about a lot, but I want to highlight it again here in this chart. So we look at this and compare what's the profit to risk ratio on a given stock that I'm trading against the profit taking accuracy, which is the historical accuracy of taking trades, how many of your trades are winners versus losers. And there's this break-even line. This assumes, though, a zero commission trade, that you're not paying anything for your commission. We talked about if you go with 150% profit to risk ratio and 50% accuracy, like in the example in the past, you're definitely going to be in this green profit zone. You're going to be profitable on the long term. You don't want to be in this red zone, right? Now, what I mentioned that is commissions. This is assuming a zero commission. So in the prior example, for example, we said 50% would be a winning proposition, although this chart says at 40%, I would be at break even. So anything above 41, 42%, I should be making money. But the answer is no, because your commissions will have a huge impact on this break even line. So this break even line, as your commissions goes above zero, obviously, which is the case for most of us, that line will push further inside. So in our example there, that break even line actually runs by slightly below the 50% accuracy. So that means you have to maintain a 50% or higher accuracy to be profitable. All right, let's take a look at two more examples about portfolio growth. So we talked about commission size or position size, now we're going to be talking about portfolio growth. And the two aspects of portfolio growth are your profit to risk ratio and your profit taking accuracy. Just remember that. It has nothing to do with your share size. It has nothing to do with your equity size, right? Because we already kind of put the nail in the coffin about how to understand your position size. So let's look at an example of fixing your profit to risk ratio at 150%, starting still with an equity of $5,000, with a maximum account risk of 2% and a round trip commission of $10. And you're taking on a trade risk of 25 cents. So this is how long it will take you to double your portfolio, to go from $5,000 to $10,000 as a function of your profit taking accuracy. So the biggest bang for your buck is improving your accuracy from 50 to 60%. That takes you from almost an infinite number of trades to double your growth, or to double your equity, to somewhere around less than 150 trades. That it takes into account that you're going to be losing some trades and winning some trades, right? As your accuracy improves, the impact does become better, but not dramatically better. But let's say you managed to push to 70% accuracy. Given this example here, you'd be able to double your account in roughly less than 100 trades. So if you take 3 trades a day, for example, theoretically on paper, 90 days, you could double your account. If you maintain a 70% accuracy, maintain a trade risk of 25 cents, maintain a maximum account risk of 2%, there's a lot of discipline here to be able to do that. And you know about emotions. Emotions take over and throw out this plan out of the window. But that's how it works. If you can remain disciplined, understand your profit taking accuracy, you'll be a profitable trader. So let's look at another example. This one where we're fixing the accuracy at 60%, keeping everything the same, and we're looking at the profit to risk ratio. So as I enter a trade, or I'm looking for that right stock and looking at what's the risk to profit, as I increase that, it has a huge impact on the number of trades it will take me to double my account. So in order to grow that $5,000 to $10,000, my profit to risk ratio, just taking it from 100%, basically saying I'm willing to lose 50 cents or 25 cents in order to make 25 cents, increasing that to 150% dramatically reduces the number of trades it will take you to double your equity. Same thing, if you go from 150% to 200% profit to risk ratio, instead of 150 roughly trades, it will take you less than 100, and so forth. Now, obviously, it's very hard finding stocks where it gives you more than 300 to 400% risk to ratio. That means for every 25 cents I'm willing to lose, I'm going to make, $1, for example, of profit. There are some stocks out there if you look for them carefully and you know how to scan the market, but it's very rare. So targeting somewhere between 150 to 300 is probably more realistic. And in this example, that shows you if you maintain your discipline, you potentially could double your equity, the $5,000, in less than 100 trades. So that's less than 90 days. All right. So the next thing I want to talk about is a deep dive into this tool that I've developed. And this tool I've developed and I use personally to determine when I started what was my proper share size should be. The tool itself is a share size and strategy growth calculator. And we'll do some kind of live demo about how to use it and how I use it. So one of the most interesting questions I got on Stock Twits on Twitter all the time is, when I started at the beginning of the year at $25,000 equity, why do I always use 2,500 shares per trade? And my answer is simple, because I use this approach. I said I'm not going to risk more than 2% on any trade of my equity. My round trip commission was $15. My trade risk, I'm never going to choose a stock. If you look at all my launch lists, especially at the beginning of the year, maybe through June, July timeframe, very rarely you will see me risking more than 20 cents a share. In fact, the average was 16 cents. But I put 20 cents, 19 to 20 cents. And my maximum account risk per trade was $500. I told to myself I will not lose more than $500 on a trade, which means that with the commission included, I'm not willing to lose more than $485 on a given trade. That put the total number of shares I should be trading at 2,500 shares. And that's why I chose the 2,500 shares. And I'll walk you through the calculator to show you more about portfolio size management and the prospects of growth based on these decisions that I chose. But the tool basically allows you to enter the 4 items we talked about, gives you what the total profit or total number of shares you should trade, and then you can do some optimization on the stock price. So up to this point, like we mentioned, there's no stock price involved. Now here it tells you based on your equity and your buying power, how many shares, what's the maximum stock price you can buy, and how many number of open trades you can have open at the same time. So you can choose whether you want to have a fixed number of open trades, or if you want to maximize your equity to go into a single trade and come out. And so what's the maximum stock price you can buy? And you'll be surprised. This third section here talks about the portfolio growth. So depending on your profit to risk ratio and your overall accuracy and your desire to double your account, triple your account, quadruple your account, it will tell you how many trades it's going to take you to double, to reach that target. And it's all summarized here. This area gives me my quick overview of how many shares I should buy. If I enter a price of stock of, let's say, $7.66, this is my profit target. This is my maximum loss target. This is in dollars amount. This is the launch plan itself. It tells me what stock price to buy, what's the abort price, what's the profit price, and what to expect from a loss or net profit perspective, as well as the portfolio growth summary. So this one says, based on all these conditions here, it will take me a total of 110 trades. 66 of them will be winners, 44 of them will be losers. I will churn through roughly $60,000 worth of equity back and forth with a net profit of $25,000, which doubles my initial equity and puts me at $50,000 as an ending portfolio balance. So it all seems simple once you understand the basic concept. You don't jump into a trade saying, I'm going to take 1,000 shares in this trade, I'm going to take 500 shares in this trade. You are going to be destined to failure. All right? So let's go and take a live view of the calculator. All right, so what you see on the screen is this recent version of Profit Mission Control's Share Size and Strategy Growth Calculator. This is a live working model. It's built in Excel, obviously, and initially it wasn't this sophisticated, and over time I keep adding a little bit more features to it to help me make better informed decisions, and eventually, hopefully, to help everybody else make better informed decisions. So anything in light blue is a variable that I could enter myself. Anything that's in gold or brown or red or green or yellow, basically any other color than this light blue, is something that's calculated. There are some options and scenarios that you can run, and we'll walk through some of these. But let's go from the top. So you enter the first 4 parameters that we talked about so far: your total equity, your maximum account risk percentage, your round trip commission, and your trade risk. The loss cap per trade in terms of dollars is what I mentioned. When you get to a certain account size, you may want to cap your total loss per trade regardless of your account size, so it doesn't scale with your account size. And I'll show you how that works in maybe a couple of scenarios. So that determines at the end of the day how many shares you should trade, what's the expected maximum loss on a trade, including commissions. And also, it gives you an idea of your percent of the commission to your max loss per trade, or maximum account risk per trade, which is very interesting. It shows you that, obviously as your equity goes down, so if you're starting with a smaller account, let's say $2,500 instead of $25,000, it immediately shows you that your commission at $15 a round trip is 30% of your loss already. So you've already banked in 30% of your loss, and you only have a wiggle room of 70% of your loss before you exit that trade. So it becomes very, very magnified, and the prospects of growth, as you will see, diminishes. So if I take that down even to $1,000, the model already tells you that there's no growth potential, because your net profit per trade is always going to be negative. Even though you're making profit, you're still taking into commission, you're still losing money. So you will have to adjust other parameters to start to see if there's growth potential or not. But let's bring it back to the 25,000, which is when I started my account at the beginning of the year. This is where I started at $25,000, 2% maximum account risk percentage, round trip commission of $15, and about 20% or a 20-cent cap on my trade risk. That put me at 2,500 shares per trade. All right. Now, once you know that, becomes a property of your equity size and the stock price come into place is determine, well, what's the maximum stock price I can buy? Well, I'll show you something very interesting. With a $25,000 equity and a 2,500 shares per trade, if I click on this button, it will tell me I can buy a stock up to $60. So I could buy a stock that's $60. Obviously, I'm going to be using all my equity and my buying power, but still, I'm not risking more than $500. So let that sink a little bit more. Even though I'm buying a stock that is $60, I'm still not telling myself that I can, or allowing myself to lose more than $500 on that trade. Now, for practical reasons, you don't want obviously to put all your equity in one trade, just in case the stock itself decides to halt for whatever reason, or obviously there's always that risk. Plus, when I put a launch list, I have multiple stocks that I plan to launch, right? Now, usually my launch list averages about 7 to 10 stocks. I know not all of them trigger in a day, but this model allows you to say, okay, if I want to manage 4 trades a day, for example, with my equity, it can actually tell you what's the maximum stock price to buy given that. So that means you can have any combination of stock prices with your 4 trades as long as they all fall below a stock price of $13.20. So the other part is your buying power multiplier. So depending on your broker, with a $25,000 equity times 6 buying power multiplier, you get $150,000 of buying power. Now, in reality, I was limiting mine to 3. Most brokers will give you 4. So I was basically bouncing between 3 and 4. If I limit it to 4 and I say I'm going to only trade 4 stocks at a given time, I'm going to have 4 positions open at a given time. This tells me, given this information, I can only trade with stocks that are on average $6.16 of price. So what is interesting about this is that the price per share and your buying power have no impact on the number of shares to trade. They do have an impact on each other, and they do have an impact of how many positions you can be managing at a given time. All right, so understand that concept very, very dearly, and make sure you use it to your advantage. meaning that you shouldn't limit yourself to only, penny stocks, even though you might have a small account equity. But you should always base it on kind of this trade-off between number of positions you want to open at the same time and your buying power, etc. The other important part of this is it shows you what's the number of consecutive losing trades to wipe out. All right. And that number is independent of any of this stuff. So it only depends on my maximum account risk. And that's it. And the commission. So let's say I take my risk to 3%. Remember we talked about getting close to gambling land? So my consecutive losing trades to wipeout goes down to 33 versus first 50. Because I'm buying, in this case, 37.85 shares. If I go to 5%, let me go to gamble road. Gamble land tells me 25 trades I'll be wiped out. So 25 consecutive losses takes me out of the game. All right, so you understand what this all represents. You understand what this all represents. Let me go take this back to 2%. And let's look at portfolio growth prospects and how, as we mentioned, profit to risk ratio and profit taking accuracy plays an important role in your account growth. So I had this set at 150% of profit to risk ratio. That was my target. I wanted to be able to do 60% or better accuracy, although when you start, you don't really know. But I had started back in October trading the system, and I had established already that my average accuracy is around 60%. The nice thing about capping your loss and having a target profit to risk ratio, you always know how much you're going to lose. No matter what, there's no uncertainty anymore. You already told yourself how much I'm going to lose. The beautiful thing is you don't know how much money you're going to make. You know that you have a target in place, but I bet you if you choose the right stocks, you will always be pleasantly surprised that your profit is going to be much higher than what you've intended. So if you're targeting 20 cents loss, maximum loss, that means for a profit to risk ratio of 150%, you're targeting a roughly 30 cent profit. I bet you in most cases, if you have the right stock setup, you'll probably be making more than 30 cents per trade. If the trade goes in the right way, obviously. So using this model, it tells me that to double my account, so if I put a portfolio growth target of 100%, meaning that I want to double my account, right? Let's say you want to take it 50%. Say you want to take it to 200%. You want to, not just double, you want to quadruple your account. So it tells you how many trades it's going to take you given a specific profit to risk ratio you take on every trade and an accuracy, how long it will take you to get to that prospect. And this is kind of the portfolio growth summary that shows you where you start. This is where you start. This is the total profit you'll make. This is how your account will look like. So basically tripling your account will take 220 trades given this kind of input. So let me go back to the 100%, and I want to show you something. So with 100%, that told me at the beginning of the year, it would take me 110 trades to go from $25,000 to $50,000. All right. I'm going to share with you my actual portfolio results that I share every week on my website on StockTwits. So just to show you an interesting fact. So we talked about capping my loss at $500, right? This is where I started at 25,000. Let's go down and see where did it double. So I reached the 50,000 mark. Now, granted, I didn't include commissions here, so that might throw it off a little bit, but basically it took about 37 trades. If you look at the count here, it took about 37 trades to reach a doubling my account, right? Now, look at all the actual profit and loss. Do you see anything more than $500? You probably don't. The maximum loss there was $500 on January 23rd. So I knew what my maximum loss was, and I never exceeded it. But then look at the profit. For 150% profit to risk ratio, that means my profit should always be at $750 or more. And if you look, there's a lot of cases where my actual profit was more than the $750. I mean, in fact, significantly more. And that's why it only took me 37 trades to double my account versus what the model is calling for here of 110. So there are three factors that why it take you shorter. Number one, your profit to risk ratio actual is more. In fact, it was probably closer to the 225%. My accuracy was also better. It was closer to maybe 68%. And taking into commissions, which I didn't into my spreadsheet that I just showed you, shows me that, you know, I could really accelerate growth to 44 trades instead of, you know, the initial 100 trades. So let's reset that back to 150 and 60. Are you wowed yet or not? Okay. Again, the point to reiterate, focusing on the loss is much more important than focusing on the profit. The profits will come once you learn how to cap your loss, once you learn what is a safe loss to accept, and once you do some discipline. Choose the right stocks, choose the right profit to risk ratio, as well as understanding precisely as you enter the trade, what is the stock price I'm buying at? What does it mean my abort price will be at? What will be my profit price or more? If you look at my results, the majority of my wins have been higher than their profit target. So meaning that I've taken more target or more profit on the winning stocks than I expected. So the rest of this model calculator shows you, like I mentioned, just a quick overview of the trade. This is kind of specific launch plan for a stock, and then a portfolio growth summary, which we talked about. Again, given these conditions, I can maximize my stock. I can buy a stock $30, right? I only have one open trade at a time, which is not wise, but it's possible. The point is, you're still not going to lose more than $500. You'll still make the same amount of potential profit. You'll still make, unfortunately, lose the same amount that you were planning to lose, right? So the stock price has nothing to do with your growth prospects. I would argue, as I started venturing more and more into larger stocks or larger price stocks, I found it easier to actually make profit because they tend to move quicker. They are less volatile from a perspective of, I don't see it go up, 20 cents and then drop 50 cents right immediately. And it gives me a little bit more of a slow pace or steady pace opportunity to enter the trade. So let's go back and say, okay, now that my account grew to 100,000. Let's say that, I managed to grow my account to 100,000. If I increase this cap, so let me say put this cap at 5,000 something. This tells me that in reality, I would have to accept a loss of $2,000 per trade. But that's where this loss cap per trade comes in. I can cap it at $1,000. So that's why now I don't take any loss more than $1,000. And in fact, I've increased my trade risk to about 35 cents on average. What I was trying to do is to still maintain the 2,500 number of shares because I don't want to really take more than 2,500. I mean, I reached a point where I think the 2,500 number is good enough. This model tells me I can go even a little bit higher and still maintain a maximum loss of less than $1,000, which is capped here. So Now I know my options. I know what makes sense. I know what is not considered a huge risk. The thing is, right now I can take stocks that, up to $100 stock if I want to, price stock. If I want to limit again the number of trades open to me to 3 or 4, that means I still trade in stocks that are $23, a little bit more. I'm using more buying power. I can put four times my buying power, 6 times my buying power, and you can get up to a stock price of $50. So obviously I won't have 4 open positions that all of them are $50 or more. So the $50 is more just a cap on the combination of stocks. So I can have 2 stocks that are $20. I can have 1 stock that's $40. I can have 4 or 5 stocks if I want to that are less than $10, and so forth. So you get the idea. So this tool is extremely powerful. It's extremely useful for me. I hope you guys get the concept of it, understand how to potentially use it yourself or develop it yourself, understand the proper number of shares you should trade, how to manage an active portfolio, how to experiment with portfolio growth, and so forth. So let's go back to one thing I wanted to show you with the $25,000 account and then the same thing here back to 19 cents, which is my 2,500. Let's talk about portfolio growth again. We talked about a little bit the profit to risk ratio and the profit accuracy, but I want to show you the kind of correlation between increasing your profit to risk ratio and the number of trades it will take. We already discussed that, but maybe the accuracy is the only thing we haven't discussed. So if I increase my accuracy to 7%, it lowers the amount it will take me to double my account to, by 30 trades. There's a certain point below which your accuracy will not allow you to grow. So here at 40% accuracy, I will not be able to grow my account, and the model tells me that. Even though I respect my maximum account risk percentage, it still tells me I'm not going to growing. Why? Because of commissions. So if I were to lower my commissions to, let's say, $10 a trade, still not a growth percent. Maybe $7 a trade, a round trip, still nothing there. $5? Nope. $0? Nope. Well, that means that 40% is very low. Remember that curve I told you where there was 0 commission? You have to be a little bit over 40. So let's put 41%. There we go. And that 41% accuracy at a 0 commission will give me some growth, but it will take me 2,045 trades to get there. Let's see how quickly it jumps if I improve the accuracy to 60%. Well, 100. So from 2,000 trades to only 100 trades. And that's kind of what I showed on that curve. You can build a lot of models or correlations using this tool to understand different scenarios, to understand your risk appetite and how fast it will take you to be profitable and grow your account. So let's go back to the last thing I want to show you is if you're starting with a very small account. Let's go to $1,000 equity. And brokers like SureTrader offer you 6-to-1 leverage. According to this, if I maintain everything the same, even with $1,000 equity account and a maximum, let me put the round trip commission for SureTrader is $15 as far as I can tell. So with a $1,000 account with SureTrader, there is no safe number of shares that will give you a net profit per trade. You're always going to be losing. So that tells you here you have to trade 25 shares a trade. Even if I max out the stock price, let me go down to like 4 here, just kind of reasonable number. So $51. But let me show you something. So what do? You're stuck. You have $1,000. You don't have more than that. But this model is telling you that you will not be able to grow it. So this is where you start to make a trade-off, most likely between your maximum account risk. So we talked about 2% being a low risk. Now, what if I take it to 2.5%? it puts me in a high risk possibility, but still no growth potential. So that's not good enough. So what about 2.75%? There is some positive net potential. It doesn't show here for some reason, maybe because there's still a net profit, a very low net profit there. Let's take it to 2.8. Still nothing on the growth. Maybe 3. So it will take me 4.25. You'll have to go into gambler land big time to be able to sustain some growth. So 4.75 roughly. So I need to go to 4.75, meaning taking 165 shares a trade with the prospects of losing $47.50 per trade. Now, if I want to also limit the number of shares or the price per share, I'd say 4, give me $7.75. So if I only trade stocks that have no more than $7.75, because I want to have 4 open trades, I can actually trade up to a $36 stock if I need to. But this is in gambler land, so it's no good. So what do? Well, can I adjust the trade risk? Trade risk usually won't have an impact. So that tells me is with $1,000, even at 3% gambling, I won't be able to grow my account. So what do? You have to start playing with this. You have to choose only stocks that give you a profit to risk ratio above a certain amount. In this case, maybe 220, 230%, 240%. Nope. So my original choice was correct, 250%. So that means if you do want to go a tad, let's go to a tad lower than that, 285, 285%. Gives me 65 shares, still not good enough. Let's go back to 3, which is really, really on the edge of gambling. So at 3%, it's a high risk. You can trade 75 shares a trade. Expect to lose no more than $15 for a total loss of $30. So 50% of your loss is coming from your commission. But it's doable. You will have 33 trades consecutive losses before you wipe out. But you also will have 1,200 trades to do 1,200 trades to double your account to $2,000. So what this shows you that with $1,000 it's possible, is just extremely, extremely hard. And you have to be really, really patient. So what if I just bump this to 1,500? How does that change the things? It changed things dramatically. If I still maintain my 3% high risk, maximum account risk percentage, I end up with only 90 trades to double my account from $1,500 to $3,000. That's doable, right? It is doable. What about 2,500? Well, that certainly puts you in a very comfortable position. You can even start thinking about taking down your risk to a point where you do get growth with some reasonable return. So at 2,500 shares, $2,500 equity size, you can trade 180 shares per trade and gives you a growth target of 100, basically roughly 100 trades should put you at the $5,000 mark. This is reasonable. 100 trades is about 3 months. Wouldn't you love to take your $2,500 and double it within 3 months? It'll probably be shorter if you have the discipline to maintain a max loss no more than $35 and only choose stocks that give you 250% or more profit to risk ratio. So I'm curious if I drop that back to my initial 150%, still growth is possible. It's just going to take you way longer, right? 1,000 trades versus 100 trades. So I think I've showed you enough of this trade. I'd be glad to maybe respond to more comments if you guys have them, or if you have a specific situation you want me to run through this model, I'd be glad to do it. Obviously, I can't share the model at this point until I develop to a certain point, and think about, well, how much is it worth for you to get your hands on this, and whether I offer it for free or some kind of compensation, because I spent a lot of time developing this, so it's not something that I just want to give out for free at this point. But I'll certainly be able to help you out if you want some coaching or have specific scenario you want me to run through. I'd be glad to do it. All right, now I want to wrap things up here quickly and cover last kind of final departing comments. So the last thing I did was ran back to the initial examples we talked about, which was Mark, Carla, and Lynn. And using the proper approach instead of their approach, Mr. Mark is certainly a gambler. In fact, when I put his 2,500 shares into the model, giving everything else the same, he is taking a 12.7% of his equity as a maximum account risk, which puts him way above the 3% threshold we talked about. And he will be out of the game within 7 trades. So if he takes like 3 trades a day, imagine this, within 2 to 3 days, he's out of the game. You certainly don't want to be there. Sure, yeah, if he nails it and he gets 2 of them winning, he will probably be ahead. But he's just gambling. He just might as well gone to the roulette table and put those $5,000 there. Carla, on the other hand, she falls into the high risk. She ended up with a 2.71 maximum account risk with a consecutive losing trades to wipeout of 36. Not too bad, but had she taken that approach, she might have lowered that a little bit, her account to maybe 2.5. Maybe it will take her a little bit, give her a little more wiggle room to go further. Lynn, on the other hand, although he didn't intend to, he actually ended up in the low risk, maybe too low. In this case, he's at 0.71 maximum account risk. It will take him 140 consecutive losses to wipe out, which is, very unreasonable, meaning that you shouldn't expect to lose 140 times in a row. So he could have bumped up his number of shares a little bit. We talked about this model. The proper share sizing would be about 160 shares. That would accelerate his growth a little bit faster while still keeping him safe. All right, so I just want to wrap things up. I'm glad you guys stuck up with me here. Hopefully you found this information useful. So the lessons learned is, the number of shares to trade depends on proper risk management, not buying power or price per share. Remember that for the rest of your life. The profit to loss ratio and your accuracy have the most impact on your portfolio growth. So if you understand them, analyze them, understand your winnings and your losses, go back to all your trades you've done so far, look at those 2 numbers, figure them out. You will be surprised by how much improvement in your trading performance you'll become if you decide to tweak those. And then growing a small account can be achieved without necessarily focusing on low price stocks. I showed you, you can actually take larger price stocks and still maintain a profitable growth. You don't have to fear, stocks that are higher than $10 or $20 or $30. Treat them the same as you do with penny stocks. In fact, they're more stable. They're more reliable. The institutions buy into them and trade them all the time. So I hope that phobia of just trading small account or small price per shares goes away over time as you understand this process better. And I hope you found this video useful. I would really appreciate it if you would just to give us a thumbs up here and subscribe. to this channel. I'd also like to hear your comments or questions in the comment section below. Have a great afternoon and take care.